Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about a stock that was suggested by a subscriber. That stock is Facebook. Today we will be looking at Facebook's business model, review the key ratios, perform a discounted free cash flow DCF analysis to find the intrinsic value of the company, and finally do an expected rate of return calculation to see if we were to invest in Facebook at the current stock price, what kind of return can we expect on this investment? So let's dive in and review Facebook. Hey guys, let's start off by looking at the Form 10-K, which is the annual report that Facebook filed with the SEC. This is for the fiscal year that ended December 31st, 2020. And on page 7 of this report, Facebook talks about its core business. In the business overview section, Facebook says that its mission is to give people the power to build community and bring the world closer together. After that, Facebook talks about the 5 products that help achieve its mission. The first product is Facebook. Facebook enables people to connect, share, discover, and communicate with each other on mobile devices and personal computers. Second is Instagram. Instagram brings people closer to the people and things they love. Third is Messenger. Messenger is a simple yet powerful messaging application for people to connect with friends, family, groups, and businesses across platforms and devices through chat, video, and rooms. Fourth is WhatsApp. WhatsApp is simple, reliable, and secure messaging application that is used by people and businesses around the world to communicate and transact in a private way. The fifth and last one is Facebook Reality Labs, which includes augmented and virtual reality products which help people feel connected anytime, everywhere. Facebook states that it generates substantially all of its revenue from selling advertising placements to marketers. Its ads enable marketers to reach people based on a variety of factors including age, gender, location, interests, and behaviors. Marketers purchase ads that can appear in multiple places including on Facebook, Instagram, Messenger, and third-party applications and websites. Now that we have a general idea of Facebook's core business, which include these 5 products and how it generates most of its revenue by selling advertisements, let's look at the company's key ratios to better understand its fundamentals. Hey guys, now let's look at the key ratios. I'm on Morningstar looking at Facebook. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company makes from its sales. So in Facebook's case, this is the amount of money that it generates from its ad revenue. Back in 2011, Facebook's revenue was about $3.7 billion. And for the year 2020, it was about $85.9 billion. We can see that every year for the past 10 years, Facebook's revenue has been increasing. Next is the operating income. The operating income is the amount of money that's left with the company once it has paid for the cost of goods and its operational expenses. Back in 2011, Facebook's operating income was about $1.7 billion. And for the year 2020, it was about $32.6 billion. We can see that over the past 10 years, Facebook's operating income has been trending upwards. After that, looking at the net income. The net income is the amount of money that's left with the company once it has paid for the cost of goods, operational expenses, interest on its debt obligations, other expenses, and taxes. Back in 2011, Facebook's net income was about $1 billion. And for the year 2020, it was about $29.1 billion. Except the drop in net income that we see in 2012, Facebook's net income every year for the past 10 years has been increasing. Next is the dividends. We can see that Facebook does not pay out any dividends. And this is fairly common for a growth company. The mentality that they have is it's better to reinvest the money that the company generates into its core business rather than paying that money out to its shareholders, because the management thinks that it's more profitable and productive in the long run for the company to reinvest that money than paying it out to the shareholders. Next is the shares outstanding. Back in 2011, Facebook had 2,361 million shares outstanding. And for the year 2020, it had 2,888 million shares outstanding. We can see that the peak for the shares outstanding was back in 2017 when it had 2,956 million shares outstanding. However, ever since then, it looks like Facebook has been buying back its shares as the share count has now dropped to 2,888 million shares. Ideally, we want to see the numbers of shares outstanding go down. In other words, we want to see the company buy back its shares because that increases the existing shareholders' ownership within the company. However, it's not uncommon for a fairly new growth company to issue more shares and do some equity financing in order to generate capital to reinvest in its core business. Next is the book value per share. Book value is total liabilities minus total assets. Back in 2012, Facebook's book value was about $4.96 per share. For the year 2020, it was about $41.32 per share. And for the trailing 12 months, it's about $45 per share. We can see that over the past 10 years, Facebook's book value has been increasing. This means that over the past 10 years, Facebook has been increasing its total assets or decreasing its total liabilities, which is causing its book value to go up. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2011, Facebook's free cash flow was about $943 million, and for the year 2020, it was $23,632 million. The free cash flow every year for the past 10 years has been positive, and we did see a drop in the free cash flow back in 2012. However, other than that one year, the free cash flow every year for the past 10 years has been increasing. This is definitely something we want to see in a company. We want to see the company's free cash flow to be increasing and staying positive. I will be using the past 10 years of free cash flows for my expected rate of return calculation, and I will be using the 2020 figure of $23,632 million for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin compares the company's bottom line to its top line. So it's a ratio of the company's net income to its revenue. Back in 2011, Facebook's net margin was about 18%, and for the year 2020, it was about 33.90%. So what this means is every $100 that Facebook made from its sales in 2020, by the time it paid for the cost of goods, its operational expenses, non-operational expenses, interest, taxes, and so forth, it had $33.90 left as pure profit. We can see that over the past 10 years, Facebook's net margin has mostly been in the double digits, which signifies that the company has a moat and pricing power over its products. Next, looking at the return on equity. The return on equity compares the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% every year for the past 10 years. Back in 2011, Facebook's return on equity was about 22.91%, and for the year 2020, it was about 25.42%. Every year for the past 10 years, except that one unique year in 2012, Facebook's return on equity has been greater than 8%. Next is the return on invested capital. This number gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2011, the return on invested capital was about 19.92%, and for the year 2020, it was about 22.79%. Given that Facebook does not pay out any dividends, it's important for us to look at how good the management is at allocating the company's capital, and a 22.79% return on invested capital is respectable. Finally, looking at the company's interest coverage. The interest coverage compares the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest obligations in a calendar year. Benjamin Graham preferred to only invest in securities that had an interest coverage of 5 times or higher. Back in 2011, Facebook's interest coverage was at 41 times. For the year 2015, it was at 270 times. What this means is Facebook could pay off its interest obligations 270 times using its 2015 income. After 2015, that is 2016 through now, we can see that there has been no reported interest coverage. This means that Facebook does not appear to have any interest obligations that it has to fulfill. Next, looking at the financial health of the company, focusing on the liquidity and financial health. First item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to see a company's current ratio to be greater than 1.5. Back in 2011, Facebook's current ratio was a 5.12, and for the year 2020, it was a 5.05. We can see that every year for the past 10 years, Facebook's current ratio has been greater than 1.5, and this tells us that Facebook has enough current assets to fulfill its current liabilities. Next is the financial leverage. The financial leverage compares the company's total assets to its shareholders' equity. Ideally, we want to see this number to be low, as it would indicate that more of the company's assets are being bought by shareholders' equity, and a higher number would tell us that the company is using liabilities in order to buy the company's assets. After that, looking at the debt to equity ratio, this number compares the company's debt to its shareholders' equity. Ideally, we want this number to be less than 0.5. Back in 2011, Facebook's debt to equity ratio was at 0.09, and for the latest quarter, it's at 0.08. The trend of numbers that we see for the financial leverage and the debt to equity ratio is comparable to its competitors such as Google. Next, looking at the efficiency ratios. The first item on the list is the day sales outstanding. This number gives an idea of how many days go by from the day Facebook recognizes its sales to the day it actually receives cash for that service rendered. Back in 2011, that number was 45 days, and for the year 2020, it was about 44 days. Over the past 10 years, Facebook's day sales outstanding number has stayed fairly consistent, and that is certainly something we want to see with a company. We do not want to be invested in a company that has a day sales outstanding number that's growing, because that would indicate that the management is taking on aggressive accounting measures to recognize the revenue early so that it can report bigger numbers on its income statement. Next is the day's inventory. Facebook does not have any meaningful inventory to report, so we don't have any days inventory. After that is the payables period. This number gives us an idea of how many days does Facebook take to pay its suppliers. Back in 2011, that number was about 19.52 days, and for the year 2020, it was about 29.45 days. Over the past 10 years, Facebook's payable period have increased. This could mean that either the management has found better ways of allocating the capital in that 10-day window and getting a return on that investment rather than paying that money early to its suppliers. In other words, if you had $100 and you had to pay someone money in 30 days, it may be more profitable for you to invest that $100 and make it $150 in 30-day window and have a $50 profit rather than just paying that $100 outright on the first day. So an increasing payables period is not necessarily a bad thing. However, an investor has to be cautious because it could also mean that the company is trying to hold on to its cash so that it can artificially inflate its cash flow from operations number. Now let's compare Facebook's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Facebook is at 25.6, whereas S&P 500 is at 28.3. Next is price to book. Facebook is at 5.7, whereas S&P 500 is at 4.0. After that is the price to sales. Facebook is at 8.7, whereas S&P 500 is at 2.8. Next is price to cash flow. Facebook is at 19.3, whereas S&P 500 is at 16.5. And finally, the dividend yield. Facebook does not have a dividend yield because it does not pay a dividend. However, S&P 500 has a dividend yield of 1.6%. We can see that on all these valuation metrics, other than the price to earnings ratio, Facebook is overvalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Facebook. Over here, I pasted the 2020 free cash flow number that I got from Morningstar, which is $23,632 million. I expect Facebook's free cash flow to grow at 11% every year for the next 10 years. Next is the discount rate. I expect this investment to give me a 10% return. After that, looking at the long-term growth rate, which is at 3%, what this means is I expect Facebook's free cash flow to grow at 3% every year from the 10-year mark into perpetuity. Facebook has 2,888 million shares outstanding, and it does not have any long-term debt. After taking all of these inputs into account, we get Facebook's intrinsic value to be about $219 per share. When we compare this intrinsic value to the current stock price of about $258 per share, we can see that the current stock price is trading about 18% above its intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows will be every year for the next 10 years. We sum up all those free cash flows, which come out to about $248 billion. Then we look at what the free cash flows will be from the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $632 billion. Then we subtract the long-term debt from this number, which in Facebook's case is $0, and we divide by the shares outstanding to get the intrinsic value per share to be about $219. Now, if we disregard the perpetuity component, in other words, if we think that Facebook's free cash flow will only grow for the next 10 years and then the growth will just stop, then we get the intrinsic value without the perpetuity component to be about $86 per share. Hey guys, now let's look at the expected rate of return calculation for Facebook. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. All the numbers here are in millions of US dollars. This is the yearly free cash flow trend that we get over the past 10 years. We can see that the free cash flow has always been positive and the trend has been upwards. Looking at the future data and predictions, I'm assuming that there's a 45% likelihood that Facebook's free cash flow will grow at 11%, a 50% likelihood that its free cash flow will grow at 7%, and a 5% likelihood that its free cash flow will grow at 1%. These are the potential free cash flow arrays that we get into the future. After taking into account the numbers of shares outstanding, which is 2,888 million shares, at the current stock price of about $258 per share, we can expect to get a return of about 3.1% if we were to hold the security through 2045. What this means is if we were to purchase a share of Facebook at the current stock price of about $258 per share, we can expect to get a return of about 3.1% on this investment. Hey guys, now let's wrap it all up. We saw that Facebook's revenue, operating income, as well as net income for the past 10 years have been trending upwards. The company does not pay out any dividends as most of its profits are being reinvested into the company to get that exponential growth. We saw that Facebook had pretty impressive return on equity as well as return on invested capital numbers. Additionally, Facebook's high net margin indicated that the company appears to have a moat and pricing power over its products. After that, when we looked at the company's liquidity ratios, we saw that Facebook is very liquid. In other words, it has more than enough current assets to fulfill its current liabilities. We saw that Facebook's financial leverage and the debt to equity ratio is comparable to its competitors such as Google. When we looked at the efficiency ratios, we saw that the days sales outstanding number have been fairly consistent over the past 10 years, which indicates that Facebook is not taking part in some aggressive accounting tactics in order to inflate its revenue on its income statement. When we compared Facebook's current valuation to that of the S&P 500, we saw that on all the valuation metrics other than the price to earnings ratio, Facebook was overvalued to the S&P 500. Next, when we looked at the discounted free cash flow DCF analysis, we saw that the intrinsic value of this company comes out to about $219 per share. And when we compare that intrinsic value to the current stock price of about $258 per share, we can see that the current stock is trading about 17% above its intrinsic value. After that, when we looked at the expected rate of return calculation, we found out that if we were to invest in the security at the current stock price of about $258 per share, we can expect to get a return of about 3.1% on this investment if we were to hold this through 2045. In conclusion, even though Facebook is overvalued to the S&P 500 and trading above its intrinsic value, we can see that this is a great company fundamentally. Facebook has little to no debt, which makes it very agile and flexible during turbulent times. And lastly, for those who are concerned that Facebook may be broken up into different segments due to the antitrust lawsuits that have been brought up against Facebook, it may actually be beneficial for the existing shareholders because when a company breaks up, it unlocks more value for the existing shareholders. In other words, WhatsApp by itself may be able to generate more revenue than when it is lumped with Facebook. Hey guys, that is all I have for you this week. Hopefully you found this video on Facebook interesting. If you do like this content, please do like, share, comment, and subscribe. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I will greatly appreciate it. Thank you.